Good afternoon, everyone, and welcome to our webinar, Autumn Budget from Policy to Portfolio. Today, we'll cut through the noise and focus on some of the key announcements from Rachel Reeves' second budget. I'm Mike Kempster, Head of London, South and East Distribution for Rathbones, and I'll be moderating today's discussion. Joining me are three outstanding experts. Guy Opperman, the UK's longest-serving pensions minister and former Conservative MP for Hexham, with experience in the Home Office, Treasury and Transport departments. Also joined by Iain Wright, Chief Policy and Communications Officer at the Institute of Chartered Accountants for England and Wales. Also former Labour MP for Hartlepool, Parliament Under Secretary of State for Apprenticeships and Chair of the Business, Innovation and Skills Select Committee. We're also joined by Nick Vaill, Senior Investment Director at Rathbones. He specialises in bespoke investment strategies and portfolio management, working with financial advisors and their clients. During today's session, you'll hear insights from each panel member as they share their perspectives on the budget. We'll then move on to answering your questions. If you'd like to submit a question, simply use the Q&A tab located on the right-hand side of your screen. We'll address as many questions as possible during the session today, and for any we can't cover live, we'll follow up with an answer if it hasn't been submitted anonymously. Before we begin, I'd just like to add that the information discussed in today's discussions and panel is based on our current understanding of the policies and shouldn't be taken as any sort of advice or a recommendation. So in preparation for the webinar, we've been speaking to our advisor community and we polled around 100 advisors about their top concerns and questions that clients have been contacting them about, and thanks to those that responded. The key areas that came up were pensions and PCLS. They left it to a matter of weeks before putting everyone out of their misery and clarifying it's not on the hit list for this year. And other concerns among that were IHT and potential changes to the gifting rules. Again, no mention of this in the announcements. However, changes to pension salary sacrifice contributions were announced, and next on the list, an increase to property income tax and a mansion tax, followed by dividends and savings tax increases and a reduction in the income tax relief on VCTs. The Chancellor of the Exchequer, Rachel Reeves, delivered her second autumn statement, while the lead-up to the announcement was filled with speculation and high expectations. So, what's the reality for advisors? Let's hear from the panel. With that in mind, what are your key takeaways from yesterday's budget and what should advisors focus on right now? Iain, if you could start us off.
Well, thanks, Mike, and thanks for allowing me to be here. In terms of what advisors should concentrate on, I'd think about timing, and I'd specialise in two areas. One is the changes, the increases in dividend, savings and property taxation, which will come in April. How will that affect how businesses, individuals will take their income? How will remuneration drawings will alter as a result of that? And so being able to structure that, I think, is an important thing. Longer term, and this is where the big surprise was for me, we saw it heavily trailed about salary sacrifices for pension contributions. I thought that was going to come in April. It's now going to come in, so the Red Book says, in April 2029. We've got the best part of 4 years to plan for that. I mean, there's a question about whether it will happen, given that it's 4 years away. But I suppose it's, how do I plan for my retirement, given that I was thinking about salary sacrifice as a big part of helping to enhance my contribution.
Sure, yeah. And Nick, from a portfolio management perspective, you and your team, like many of our colleagues around the business and advisors, have been fielding questions and concerns from clients and their advisors over the speculation. Now you've had a chance to review yesterday's announcements. What are your thoughts on those?
I think initially a sigh of relief, a bit of a bullet dodged, but the budget is something of a sticking plaster. I think some of the conversations that we've been having with advisors and their clients, some of the potential panics, clients thinking about rushing, taking out their lump sums from their pensions, lifetime gifting, or indeed actually taking out their investments entirely, thinking about the budget implications on overall portfolios. Yeah. So I think we can draw breath from that, and advisors, with our help, can get back to business as usual, thinking about the lifetime gifting, thinking about sensible pension planning. So sorts of things that had been on the agenda quite a lot, family investment companies, for example, get back to that BAU.
Excellent. And Guy, let's hear your views.
So I think listen, Napoleon said, give me a lucky general, and she was very unlucky. I felt genuine sympathy for her because the OBR leaked it all beforehand, which kind of stole the thunder, but also spelt it out, by the end of the Parliament, taxes will be up, debt will be up, productivity and other things will struggle. So I think we dodged a bullet in some respects. The lump sum is a great example of, I think all of us felt that was under threat.
Yeah.
The question is whether that is off the table forever. I personally don't think it is. But we are in a position that many things that probably should have been done, reduction in spending, getting your interest rates down and your bond rates down, probably haven't been tackled. And that, I think, is a long-term worry for the economy, which we all want to see do well.
Yeah, I agree with that. So thanks for sharing your thoughts and your insights on that. It's always helpful to kind of hear different views and perspectives. Advisors just want to help clients plan for their future. So it's good to get the wider context and the potential implications of these changes. So let's move on to the pensions aspect of it. So we've seen the introduction of the pension salary sacrifice cap, coupled with last year's budget bringing pensions under IHT rules back into the estates. Let's hear why and what the future might hold for that, because you made a couple of references. So given the introduction of this cap coming in, and Iain rightly said in 4 years' time, how do you think this will impact on pension contributions and the incentive to save into private pensions for retirement? Guy?
Well, I think there's 3 key points. The first is, the negative is people will hear tax on pensions. And that is just not a good thing at all, because there's been a consensus for a long period of time that pension saving is something that is effectively not taxed on the way in. Yeah. So that is you've got to get through the noise of that. Now, I think it's doable, but the long-term consequence is they would like everybody to put more into a private pension than your personal pension. I think I'll believe that when I see it. And I'll also believe it that employers are going to struggle, because they're going to be going, well, who's going to pay the NI? And inevitably an employer will be going, well, I don't really want to pay this. The employee will be going, well, I don't want to pay this. And that, I think, is going to take some friction. And I think, Iain is right to highlight the fact that this is 4 years away, because there is a real scepticism, I think, amongst all politicians and commentators that this will definitely come in, 3 weeks before the next general election. I don't personally see that happening.
Yeah, interesting perspective. Iain, from a tax point of view, pensions have been an attractive planning tool, reducing income tax and increasing the long-term savings. So how will this affect businesses with the changes brought in by Rachel Reeves yesterday? And do you think we could see a shift away from salary sacrifice arrangements over to DC schemes where national insurance doesn't yet impact employer contributions?
I think the short answer is yes. I think you're right to highlight income tax as well. One of the problems of our tax system, and believe me, there are many, is the cliff edge. And it's, what incentivises someone to take a new job, to get a promotion, to earn £125,000. And it's a case of, well, do you know what? The tax take as a result of that promotion might be a big hit. So what do? Well, actually, I'll put money into my pension to reduce the income tax and reduce my salary. That's a good planning tool. That might be taken away. I think Guy's absolutely right. Whether it will happen, I think we have to be sceptical. I think people will go, well, I don't want salary sacrifice. Can I get some sort of relief at source? So can I change the nature of how I get my pension contribution? The thing to remember is there will need to be changes in employment contracts. Millions of employment contracts. Yeah, sure. And it will be, that's going to be a massive admin task. Get into HR as a business, because that is going to be huge. Yeah. But it's a case of, well, what else should I be negotiating as an employee to my employer? Should I be saying, well, I want other benefits. I want you to pay to make up the shortfall. How are you going to do this? So there will be big things rather than just solely on this pension contribution through salary sacrifice. I think it will change an awful lot of employment law and employment contract.
Potentially unwanted administration.
Well, the whole thing is, but in terms of, our members, our chartered accountants, IFAs will be thinking the same thing in terms of it's too complicated, it's too uncertain. This adds to the complexity, and government has talked about let's reduce regulation, let's make sure that bureaucracy is reduced. don't think this measure helps.
Yeah, no, sure, I can see that. Nick, let's bring it back over to you for a second. With these rules set to come into effect in the next 4 years, it feels like there's still time to plan ahead. How will you be working with advisors to plan for this, looking at portfolios? And how do we think advisors can pivot a client's retirement strategy? And what flexibility do you have?
I think there's a balance to be had. There's, on the one hand, if we think about the immediate and probably longer term financial impacts of the budget, just looking back at the last 24 hours, there was, in 10-year government bond yields in the UK, fell by about 7 basis points, which in government bond terms is quite a lot, but it's 7 basis points. There's not a huge change. Clients, when typically after budgets, you see price movements, good or bad, gilt yields, and in sterling, say against the dollar, and there hasn't been a bit of sterling strength, but no huge movements. The bigger impact really has been, there's been a bit of a greater increase in the likelihood of a cut from the Bank of England from about 86% to 93% in December.
Yep.
But in reality, with our DFM hat on of managing IFA client money, the bigger thing is that in the US and markets, back to approaching record highs. A week ago, there was a 30% chance of a Fed rate cut coming up. Now it's 80%. So actually, the budget for client planning for advisors and from our perspective of managing portfolios is important, but there are bigger fish to fry.
Yep.
On the other hand, in terms of planning a bespoke DFM, as we are working with advisors, we can be wrapper agnostic. So planning for clients, as we have been doing, and I think post-budget is even more applicable. So loads of opportunities for advisors and for DFMs such as us, where we've got, for example, offshore bonds, ISAs, GIAs, etc., that we can work together and plan best to match client objectives.
Yeah, no, that's really interesting. So flexibility and
Yep.
and just communication in working with people. A question to all of you guys on the panel. With the climate of potential pension reforms and stuff on the table, off the table for the future, what interim action should advisors take now to stay one step ahead?
So shall I go first? I think, listen, I think all of us felt that the 25% lump sum 267 was up for grabs, putting it bluntly, because she could have saved $1 billion or possibly $2 billion by reducing it to, say, 50,000. Yeah. The fact that that was not done on this occasion, I think, is a pretty good signal that it's not going to happen. I really do, actually. And there is wider Treasury evidence that the Treasury like it because people take the money and then spend it in the economy, and that stimulates growth. So I think if you were talking to an advisor, you would be saying, look, that seems pretty certain for the foreseeable future. And although every budget now has this discussion, it doesn't seem like this is going away, which is quite important because long-term planning of the 267 for the sort of clients you have is really, really important. For that, I think it matters. The other bit that really follows on from the budget is, where does that leave inflation? Because Nick is totally right that there is a rate cut coming, but if inflation spikes on the back of a couple of the various measures, then I really worry that we're already an outlier on inflation compared to our European colleagues. If that pops up, particularly if the American inflation pops up, then that has a wider impact on a whole bunch of fiscal measures.
Mike, can I just...
Yes.
Guy, I'm interested in what you say there in terms of inflation. You think as a result of the budget there might be a bit of a spike?
Yeah, I do.
On what basis?
So you look at some of the increases to minimum wage, you look at some of the stuff that they're doing in terms of the spending. The welfare budget's going up by 73 billion over the course of the Parliament. They haven't reduced some of the spending that one would have hoped. I know we all know it's very tough that you'd hope to do so. So there's a bunch of commentators. I sat down last night. I don't get out much, so I sat down to dinner with some Bank of England people, and they were going, "We're nervous about inflation, no question."
Because I'm interested in that because I spent this morning with a chief economist of a major bank, major UK-based bank, and she was saying, we're going to get a rate cut in December now. I'm absolutely confident.
So I agree with that. All of us agree. All of us agree. My worry is, the Bank of England definitely want to cut rates. The problem is their job is to also stabilise inflation. And the worry is that they are going to go down a particular path, but inflation will still remain, as my Bank of England colleagues described it, sticky. And that is not good.
I've derailed your conversation, Mike, so I do apologise.
No problem.
I was just going to say, I think the advice I would be giving is don't be too hasty. Make your decisions based upon actual evidence.
Yep.
I think Nick's been absolutely right. Guy's mentioned this as well. I think what's really damaging is not the OBR leak. That is embarrassing and mortifying.
It's fine.
The speculation constantly since September onwards has had a really chilling effect on investment in this country. It has hindered growth.
Yes.
That has to stop. I feel really strongly, the days of Hugh Dalton having to resign as a result of an inadvertent budget leak, when flying kites, people, and Nick mentioned this in one of his remarks, people pulling out of their pensions based upon that speculation is deeply damaging, not just to the individual, but to the whole economy. So base decisions on evidence and on what's actually facts rather than on terms of this speculation, which is dreadful. This is no way to make spending and taxation plans for a major economic power. Absolutely not.
Yeah, no, that's quite interesting, and look, we did go off at a slight tangent, but I think it's relevant. So whilst we get caught up in the weeds of the specifics, let's take a step back. How much of this budget is likely to stick? And what might not make it to Parliament?
I remember the time when we had the omnishambles budget in 2012, when we decided it was a good idea to put VAT on a Greggs pasty. And 3 days later, I was walking down Prudhoe High Street and I was pursued by a man dressed as a pasty. And this was then on TV subsequently later.
So you can watch it back on YouTube.
Yeah, you can. Basically taking away their birthright, and white van man, pasty lovers and the Sun all combined in this horrendous campaign to force the government to stop tax equalisation on baked or non-baked goods. My point being, it has to be a particularly sensitive thing that captures the zeitgeist for it normally not to fly. So that was a good example where mainstream media, individual white van man, your average voter who you really quite want to get on with, all said this is a bad idea. Right. Salary sacrifice is not that. At first blush, my view is it's not got that sort of zeitgeist, the feel of something that everybody will get upset about. It makes a really fair point that there's a ton of SMEs and small businesses and bigger businesses who'll be going, oh, this is a HR headache. I'm now going to have to renegotiate contracts. It's going to cost me. I don't think they've really thought through those implications. I think they really would just not look at it. You're doing it because of the OBR. So the OBR, in all their wisdom, counts stuff on a 5-year basis.
Sure.
So I pass something that's going to happen in 2029, but it is counted today as if I have done a tax raise.
Yeah.
So every time you see the taxes are going up in this Parliament or by reason of this budget, it hasn't actually happened until 2029, and question whether it will get through.
Yeah.
The bit that I think the two of us with our political experience think really weird is if you're going to put a tax raise, you do it at the start of Parliament, right?
Yeah.
The one thing you don't do, particularly if there was the slightest risk that the present Chancellor and leader might not stay, pass no comment on that, is go, do you know, at the start of the future general election, next general election is on the 1st of May 2029, right?
Yeah.
Almost certainly. So on the 3rd of April 2029, you whack in a ginormous tax raise. That is something that if you were the Prime Minister going to the country, you'd be going, why are we doing this?
Guy, spot on.
Yeah.
Conventional political wisdom says you make the difficult decisions in the first 2 years of a parliament,
Sure.
and then you start giving voters some benefits towards the end as you're coming up to the general election. In the two budgets of this parliament, first year there was a spend of £40 billion. This year it's going to be £26 billion.
Yeah.
Big sums. And then it tightens. The fiscal tightening in the last 2 years of this parliament is quite astonishing. Will that happen in the run-up to a general election? Really?
Yeah.
So, I'd question what is going to happen in this. Will the budget stick? I'm not entirely certain in that regard.
Sure, that's quite interesting. We've seen a pattern forming here, I think. Iain, let's turn to the increase in dividends and savings tax increases and the changes, and not forgetting the slash of income tax relief on VCTs. What's your take on these changes? Are there some positives and negatives in there, and how can tax advisors, financial advisors work together with clients to ensure they've had the opportunity to review different planning strategies to mitigate these?
I would take two things differently, Mike, and I don't agree with you on one of them.
Sure.
So in terms of dividend and savings, in terms of really making sure that advisors have the facts in front of them, can provide that bespoke advice to individual circumstances,
yes,
is really important. I'd be interested in Guy's political take on this as well, though. I get the sense, my political spidey sense is telling me there's a feeling, well, actually it says it in the Red Book, I mean it's quite explicit, that income derived from assets is not doing any of the heavy lifting in terms of what's needed.
Yeah.
So, dividend, savings, property will be increasingly squeezed, I reckon. Yeah. And so I think advisors need to be maybe prepared for that medium-term change.
Sure. Yeah.
Where I quite disagree with you, Mike, is you talked about the relief on VCTs. I agree that in terms of that front-ended element, but it seems to me to be a timing thing. I think the VCT stuff and the EIS has been a fantastic long-term measure that can really boost growth. And it's been successful precisely because it has been stable and long-term. I think in a budget that didn't have that many pro-growth measures that would attract investment, the VCT and the EIS stuff is a really good shining example of where there is stuff. So I don't agree with you. I think this is great stuff. Use it to the best of your ability if that's necessary.
That's excellent. Thank you.
Let me come in on that. It says, so successive governments, and I was part of it when I was Minister of Pensions, have looked at the way in which the UK doesn't really invest in the UK, right? And you look at our pension funds, massive organisations, huge amounts of cash. Fundamentally, you look at the Australian ones who went 45% invested into their domestic economy. Ours is basically less than 10% and going down, right? So you try and pull levers as ministers, secretaries of state, chancellors, PMs, of which Mansion House 1 is a really good example, and the Mansion House 2, which was Rachel did fairly recently, is a secondary example, which is you say to people, spend money on UK infrastructure, UK private markets. Everything about this government, they have got a really good plan in the pension space to try and use pensions for growth. That is absolutely, and to be fair to Emma Reynolds, who was the architect of this, she went around before the election and they had a properly formulated plan, slightly building on what we were doing, to say, we will take large sums of capital and direct that to try and get infrastructure, private markets, investment and everything, of which we have a problem in this country. In that if you go down to Shoreditch and you see all the lovely startups and all the fintechs and all the biotechs, they get their first bit of money, but their secondary source of money, which is exactly what Rachel mentioned in her speech, her secondary source of money almost always goes to American private equity, right? Which means we lose the investment, we lose the business, and we lose the profit in the longer term. So we are trying to drive, she is trying to drive, money into secondary finance and tertiary finance of startups and entrepreneurs and EIS and VCTs. It's entirely the right policy. And you can actually see a narrative and a thread of all the things they're trying to do, which they should be applauded on, frankly. And I go one step further. One of the policies I was trying to persuade them to do was to look at how it is you can use ISAs for investment. So interestingly, they've taken the 20,000 ISA, they've then said, all right, you can keep 12,000 of it, but certain cohorts, up to retirees, you've got to take 8,000 and you've got to use that for investment purposes. So your wealth managers will be having to look at, all right, it's fine, so I've got to find an ISA that I've got to put 8,000 into investment. That again is part of the same narrative, the same story. We want to use private capital, whether personal or pension fund, to try and drive forward growth in this country.
The other thing to mention is, we are sat in the heart of the City of London at the moment. This is still, one of the great places anywhere on earth to attract investment and capital. But it's been under challenge in recent years, and in terms of listings, that's been a real difficulty. But there's something in the budget yesterday in terms of the stamp duty exemption, in terms of 3 years. That will help as well. That's a really good pro-growth measure that should be applauded too. So, building on some stuff, maybe not enough. That's always the way, every single budget since Gladstone has always said missed opportunity. But I think on things like EIS and things on the stamp duty exemption, I think those are really good pro-growth measures.
Yeah, brilliant. Really nice to see some positive, and thanks for challenging us on that point to kind of highlight those. Nick, how does this impact how you look to construct and manage portfolios for advisors? And what tools do you have to help them?
Yeah, so I think using ISAs as an example, in the environment in which we're in, IFA clients, long-term clients, we've got lots of ISA millionaires, which is wonderful. I don't quite agree the ramifications from my perspective of that 8,000 ISA allowance. What difference would it make? I think if you want to hold cash, you'll probably still just hold cash, just not in an ISA perhaps. And certainly from our perspective as managing clients' money, we do have that global. We love investing in British businesses, but we're comparing against global benchmarks, and so we need to compete.
You've got a Magnificent Seven, and of course it's not going to move the dial, but it's like part of all the measures that you've got. You can see why Treasury have gone and done it. That's
especially versus trying to ram in a British ISA. That would have been impossible.
Agreed.
And I think in terms of managing portfolios, so it hasn't fundamentally changed our approach. I think but there's a huge land of opportunities for advisors. I think because there's so many things that they can do to help clients. To make things as tax efficient as they can. So, for example, the fiscal drag, where you've got clients that they're going to be more and more captured into higher rate tax or additional rate tax, with appropriate planning, capitalising income or using an offshore bond or whatever it may be, with good advice, advisors and we can really save clients a lot of tax. I think in terms of tax efficiency within portfolios, that's really important. And so, as an example, where appropriate, we use structured products, which can really generate some great returns for clients. We use them obviously very sensitively, but they do tend to capitalise income. And in terms of the different taxation rates that still apply, thankfully, not being the stuff that we can hold for clients, get returns either tax exempt or as capital gains is really helpful, especially for those high net worth clients and ultra high net worth clients. I also think we are as a business pivoting to how can we better help, and so cash flow planning with advisors, markets are at or around record highs, so maybe we generally want to look further out post-budget in terms of, depending on the level of cash flow needed, planning carefully. But then as a business, we've got a formal retirement drawdown strategy imminently being launched, so we'll be sharing that with advisors very shortly. That's above my pay grade when that launch date is, but it's coming.
More on that later.
Yeah, absolutely. I think that active management, so we as the portfolio manager, where there are nuances because of things like the budget. So yesterday, for example, with the pre-release, suddenly the house builders fell by 4% or so, then they bounced back. The banks have kind of done okay out of it, so they've nudged up higher, but with a proper active manager as we are, we can take advantage of opportunities and threats. So I think that, combined with the sorts of things that advisors will be thinking about, do we go unwrapped, do we use general investment accounts, all the different bits, and we've got lots of great case studies that we can share with advisors. So I think it is kind of business as usual. Those are all things that I've said before, so it's not really kind of necessarily changed by the budget, but I think there are so many different layers that advisors can think about to help clients.
But I think, listen, it's a major step forward that you're doing a retirement product whenever it is so launched, above all our pay grades. But that is going to be massive going forward. And if you're an IFA sitting there going, so I can take something off the shelf, which is a proper drawdown product, that's a big deal.
Yeah, no, I think you're right, and we'll plug the webinar later on in the session. But Guy, Iain, just finish us off on this. I mean, I think we consider these tax hikes. Does this make pensions more attractive over taking dividends if a client's a business owner and maybe of a certain point in their planning?
Do you want to go that first? Because you're probably the dividend expert.
Well, I wouldn't go anywhere near that. I think the short answer is, at this moment in time, 24 hours after the budget. No, it makes pensions less attractive. But it makes dividends less attractive as well. So it's where do you need to go?
Yeah.
But in terms of, and again, it comes back to one of the shortfalls of our taxation system, not Rachel Reeves's fault. Successive governments and chancellors have dealt with this. The constant tinkering with the tax system does not lend itself to a stable environment to allow for investment. And that's what we've got to get to. One of the things that's really striking, I don't think any government is doing this. Guys, your government didn't do it. The current Labour government is not doing it. How do we deal with tax simplification? I think that's really important, in terms of just freeing up businesses, not to think about the tax.
The book gets bigger, and the tax book gets bigger and bigger and bigger and bigger. And everybody talks about, we're going to make it simpler. And inevitably, they just tweak a bit around the edges because proper tax reform is really chunky. Obviously, there's winners and losers, and everybody just shies away from it. There's no question it happens.
The tax code's 23,000 pages long.
Hefty.
And it gets bigger. Every single government has made it bigger. I'd love to say, it doesn't matter your political persuasion, it always gets bigger. Yeah. So I'll try and answer the question. So I think it's a negative for both, I'm afraid, because you've got a situation where dividends are clearly going to be treated in a different way, and you've got a situation where the average man in the street, the average man who's driving his Mondeo to work, taking the tube or the train to work, what they will hear is taxes on pensions. Now that is not a good situation. Yeah. We've had successive governments, including this government up to now, have said, no, we know that you're not going to be taxed on the way in. And that is I just think that's a bad narrative. I still think, listen, if that's the only impact on pensions, I think we all collectively drew a sigh of relief, frankly. Nick expressed it very well. Yeah. That if that's the only impact, that's okay, frankly. And we've dodged a few bullets that could be way, way worse. We could have been having a chat where we're going, 267's now 50,000, which is in the Resolution Foundation report. Yeah. It's in Dawson Bell's book. He wrote the budget, That's kind of where we all thought we were going. Yeah. And if this is the only change, then we can all live with it. But it kind of goes back to the tinkering point. You've satisfied the OBR and the bond market for a tax rise that we both think probably will never happen. Yep. That calms everybody down in terms of the bond market, pays for a variety of stuff, so you can say fully funded welfare increases or whatever. But it isn't actually giving the right positive message to investors and the average man or woman in the street, not just the Rathbones investor, the sort of wider investor, all the normal people up and down the street who are going, I should put some more money in my pension. It's a really good thing.
I'd contrast pensions with what I said with EIS, which is EIS, I can't stress enough what a fantastic product that is. Attracting investment, but it's been stable. It hasn't been tinkered with. Yeah. It doesn't change, and that gives confidence. And I think if we're going to start with the constant tinkering of pensions and the erosion of that consensus that Guy rightly talks about, which is, do you know what? In the main, you're not taxed in, and government. It's in government's interests to give you a bit of relief on the way in, and you'll be taxed on the way out. That seems, and I hope we don't break that down. The other thing to mention, Mike, I'd be really interested in a very esteemed former pensions minister view on
Stop
this.
there, that's too good. It's
a really inept pensions minister. I'm surprised we didn't have a shift in tax relief on pensions contributions for higher earners, where you just get a flat rate of, 25, 30%, something like that. Point. And I just wondered, you must have had lots of discussions about this, Guy. We are heading very fast towards the middle of the Parliament, and it goes back to the point, do you make these decisions in the latter half of a Parliament, in the run-up to a general election? Sure. I suspect not. But in terms of, have we dodged a bullet there, or is that coming next year?
So I think I can answer that. So, we're not here to describe how we got to where we are. Yeah. The old gag with an Irishman is you wouldn't ask him for directions. If you ask him for directions, he'd say, well, you want to start from here. However, you have to look at the last budget, which was, this is the one time we're going to put up your taxes. This is the one fiscal event of any difficulty, right? And for whatever reason, we're not in that place and things have got more complicated this year. the question then follows is, where does the economy go over the next year? Because Iain is right that if the economy does not prosper, if we don't get growth, if we are continuing to frankly lose money as a country, and debt gets worse and bond markets get a bit leery, etc., then she has to come back and she has to then go, well, what else can I then go for? Of which the really easy opportunity is clearly pensions.
Yeah.
And sadly, I fear that the answer to Iain's question is utterly in how does the economy prosper over the next year? That's the key question for me.
Yeah.
Because if the economy prospers, I think there won't be any change whatsoever. The difficulty is if the economy does not prosper, and notwithstanding the wriggle room that she's given herself in her fiscal rules, then I think we have to come back, and again she has to go, where do I get the tax raising powers from? Where do I get the money from? How do I make fix this gap? So I think it's a wait and see point. We had lots of discussions. So every budget, individual ministers go into Treasury and have discussions with them. And on repeat basis, you have discussion about, we'd like to do this or we'd like to do that. And you try and justify and explain that. And that happens all the time.
Yeah.
They will have had a discussion about this, particularly because the bloke who wrote the budget is Torsten Vaill. And helpfully, he's written an entire book on what he'd like to do to the fiscal system. So you can actually look at his book and the chapter on pensions where he does talk about a flat rate. And many would say that he is the sort of nailed-on next Chancellor were Rachel to not be the Chancellor in the future. So it's still up for grabs is the point, but it's entirely dependent upon what happens to the economy.
But just playing devil's advocate in terms of the tinkering with the pensions, both on the way in and the 25%, they haven't changed. So is it unfair labelling the government tinkering in the pensions when those two really important things have, maybe only temporarily, but they have actually been retained for now?
They have been retained. The problem is, you come back to the salary sacrifice stuff, that is, you are taxing on the way in. Now, it may be very peripheral, it is small, it's not a big deal in the grand scheme of all the things that we talk about. But it comes up, you pop BBC ITV on, it's pensions are being taxed.
Sure.
That's and I'll bet you anything you like. IFAs out there will be dealing with clients who go, what's this business about taxes on pensions? Which is, it's just not what you want to hear.
The other thing I'd mention, it's in response to your first answer to Mike, Nick, which is, in that speculative time in the autumn where you had loads of these kites being flown, I'd be interested in your real life take. What were clients doing? What clients pulling out the pensions on the basis of this speculation, going, well, I'm gonna jump before I need to be pushed. Deeply damaging. I can't stress this enough in terms of how bad for investment growth and ultimate, individual decisions.
We know the answer to this because the Bank of England have actually published the statistics. It's like 38% increase in pension withdrawals taking early lump sum. Particularly on the back of a couple of announcements. You can actually, they've got a bunch of data on this, and I'm sure your clients would have exactly the same.
Yeah, I think I've been desensitised by the experience running up to the budget last year, where other than financial crisis, COVID, I'd never been busier fielding calls where people were very concerned about capital gains tax. So relative to that last year, where we were crazy busy, trying to keep people calm, but also respecting their wishes with their money, this year, in my team, as an example of the wider firm, we had a good number of clients, including advisors with their own money, taking their lump sums out, but generally for justifiable reasons. There were some people, both in terms of what's the upside, downside, and you could understand the risk, especially given the risks we all thought were there. And then there's the wider panic about markets and trying to reassure that the budget is really important, but there's a big old world out there as well.
Yeah, brilliant. Guys, great discussion, and without wanting to get caught in a tax trap, I think we should move on to discuss property. So if we look at that, is it another blow for the property market? I think from our conversations, I can sense that you guys both have, and Nick have some key insights on the topic. And can you share these with us? Looking at introduction of mansion tax, increase in property income tax. where does it leave us?
So I'll start. I think clearly those things are a negative to property as a whole, but you might say, well, that's high net worth property. I think of far greater importance is other measures the government has introduced. The Renters Reform Bill has had a seismic impact on the rental market, and it will dramatically reduce the number of properties out there. If you were a landlord 10 years ago, lots and lots of your clients, people we knew, would have property as their alternative version of a pension, right? And successive governments, and all governments have done this, but oh my gosh, it's been ramped up lately, have basically clamped down on landlords. And there would be very, very, very few people now who would be either advised or intend to utilise property planning as part of their pension portfolio.
Sure.
And on a whole host of levels, not least you're going to get double council tax, you're going to get a whole bunch of other things. It is quite clear that property as a alternative vehicle for your long-term financial planning is really not a wise move.
Yeah.
Just to build on that, Mike, and build on Guy's comments. So I was housing minister under Gordon Brown, 2007 to 2009, and I had responsibility within my brief for the private rented sector.
Yeah.
I was a Labour MP in a Labour government. Did I want to see Rackman levels of slum and mould on walls for families? No, certainly not. I didn't. But what I was really mindful of was I didn't want to reduce the housing stock. I didn't want to reduce the number of rental properties, and so you've got to strike that balance there. Yep. Because landlords could respond by going, well, I'm not going to bother, I'm going to take my stock out of the market. And that would have been dreadful, at a time when we want to increase the stock through building as well as providing, different alternatives. That would have been a nightmare. And so I worry about that as well. What's the right balance? As I said, I will never ever sit here and go, well, do you know what? I don't care about the level of quality. It doesn't matter if you're living in a slum. Of course it does. Yeah. But what is it that you've got to make it a degree of attractiveness.
Yeah, okay. Nick, I'll come back to you in a second. I just want to remind our listeners and thank you. If you do have any questions, do start filtering them through. We're going to kind of finish up on this topic, then look to head into a Q&A. So send through any questions that you've got and we'll get to those shortly. Nick?
If I was an advisor, I would be thinking which of my clients have buy-to-let properties, individual or on a bigger scale.
Yeah.
And is there an opportunity to help those clients who, we were having lots of conversations before the budget about people being fed up with property because the environment is just getting less friendly for that sort of investment. It's been a great source of business for the advisors and for us that we work with. Yeah. Whether that is people looking to sell their properties and invest in another way, which may involve investing in financial assets, one would hope. Or we also are having some clients where they've got large property portfolios and they're looking to borrow against them to diversify their financial asset exposure. So I think there's quite a lot of opportunity there for advisors to look at. I think I can't help but flag our research team published a great article, Don't Bet the House, which is effectively saying, would you bet in the next 10 years on a portfolio of diversified financial assets or on the UK residential property market? It's a really good read from a couple of months ago, but it's really relevant now as well.
I totally agree. Listen, anecdotally, I think you speak to any rural community MP, they will tell you that their rural housing stock is disappearing because bluntly, the individual landlords are selling as second homes and just cashing in, and certainly unbelievable vetting of tenants that is so expensive because they're so worried about the consequences of this. I just do not see people moving into property as investment.
Successive governments have been concerned about absentee landlords and the effect on local communities. You in Hexham, Guy, will have seen this. My own constituency, and it doesn't take much. It's like gaps in your mouth in terms of teeth. the decay spreads, and that has to be stopped. So it's a case of what are the provisions that need to be put in place that landlords care about the properties and the communities that they operate in. But that's a balance in terms of not making sure that it's too onerous. You want to have private rented, possibly as an alternative investment vehicle, but certainly in terms of that supply of housing, which is attractive, which is high quality, which attracts families in.
But that's a government decision. The problem is, if I'm an individual investor or I'm being an advised investor, they would look at the repeated changes under successive governments and go, the margins are not there and the downsides are significant, I'm afraid. That's the practical reality.
Yeah, brilliant. Excellent. Thank you very much for that on property. Let's move to some questions from our listeners. So thank you for those who are sending questions through. We've got some really good ones. I think we're lucky to have Guy here and Iain here, so we'll pick up some tax ones and we'll pick up some pension ones as well. So I think let's start off with a question from Darius. So, for advisors as business owners and advising business owner clients, with NI going to apply to salary sacrifice, it appears that it makes more sense to pivot away from salary sacrifice pensions for staff and favour more larger employer contributions. And we briefly touched on this earlier. So
yeah,
would
the
you
answer is yes to that, without a shadow of a doubt. And I think that is the sensible and the pragmatic and the fiscal right decision to do so. The question will then be, though, there will be some employers who will be going, well, why should I pay for the cost of the NI on this? Yeah. Or the individual going, well, I don't want to be any part of this. I want to make sure I'm in the same situation I used to be in. And you'll find in sectors where there is a real fight for talent, so digital services, for example, or middle management in certain key sectors, those people, you'll find employers will be saying, no, I'll cover your NI. That won't be a problem at all. Don't worry in the slightest, there'll be no change whatsoever. In sectors where that doesn't apply, it'll be more complicated.
My answer, Mike, would be very much agreeing with Guy. It would be yes, but. So absolutely in terms of what Guy said, I think he's spot on.
Sure.
But the timing. And as I said, the thing that shocked me was April 2029. So that increases the level of certainty about whether this is going to happen.
Yeah.
But it gives time to plan.
Excellent. Okay, thank you. And question from Natasha. So thank you for this question. Do you think a private pension buying a lifetime annuity with or without a guaranteed period or value, protection and death benefits will be subject to IHT? And how do we think this might be calculated for IHT? No different to a final salary or a pension scheme income, perhaps?
You're asking a future tax question that hasn't even been decided. So I think my answer to that is probably I don't think that is going to happen, because if the annuity market is pretty established, but you're speaking, I'm not enough of a future tax specialist, I think is the fair point, going to your disclaimer earlier on as well, but I just don't see it happening. I think there is a much better argument, which is, and I don't work for Rathbones, is that why would you be buying a simple annuity if you can buy a better retirement drawdown product, which in theory should give you a better return, which is what everybody's trying to do in the private pensions world. And if you can create a vehicle that gives a better return from an annuity with similar amounts of money because it's invested in a better way, and then why wouldn't you do that?
Yeah.
I don't understand how you could tax today future revenue streams. In terms of that just defies logic to me.
Yeah, but
it's not something that
you're totally right, but here's the problem: if the economy goes south, then all the bets are off as to what it is that you're going to necessarily look at for future taxation. That's my nervousness.
Yeah, brilliant. And I think considering that question, and I think it's clear that advisors are going to be looking to the future. So a great question from Terry. Given the political motivation to defer the impact of the announcements made this week, is there a scenario where an earlier election might be a possibility? Therefore, do we need to be mindful of that in our advice process and thoughts?
I'd say no. I mean, famous last words. My sense is this government lasts to a general election date of the Prime Minister's choosing, because we've lost the fixed term parliaments now. He'll go to the country, or a Prime Minister will go to the country in 2028, 29. We haven't talked about there's a 3-figure majority. It's a big majority along the lines of an Attlee, a Thatcher, a Blair. So in terms of getting the government business through, the government is not going to collapse. There's a slight concern, slight risk about, is there going to be a crisis in the bond markets where, lose confidence? I don't think, I think the Chancellor is very mindful of that. So I don't think that's going to happen. I think this government, this Parliament will run till 2029.
1st of May 2029, nobody will be going to the country early. Also, why would you go to the country early if you are, sadly, regardless of your politics, you're miles behind, all right? You will spin it out, as, by the way, John Major did, Gordon Brown did, David Cameron did. They will go to the end, not least, and Iain makes a perfectly valid point, you're the first time in government for, 14 years. You have an opportunity to look at your manifesto and your various things that you want to do that are on your tick box of things that you really, really want to do. You need time to do that. You have to consult and go through things. You have to do primary legislation, secondary legislation. If the shorter the Parliament, the harder it is to get things done. So you might only get one shot at this. So go the full term, and I think that's exactly what they'll do. And the date that I'm absolutely certain they'll go for is the 1st of May 2029.
And the other thing to mention, Guy and I have both said, that the political cycle, the electoral cycle is, you make the difficult decisions now and you get the dividends politically at the end of the Parliament. Actually, and some of the things will need time to materialise. One of the things that we should credit the government for is planning reform, that infrastructure. It takes time to get, the spades in the ground.
Yeah.
But that might be coming to materialise, to see tangible benefit in 2028, 29. Why wouldn't a Prime Minister and a Chancellor want to go long to make sure they can cut ribbons on new sexy buildings in 2028, 29?
I've cut a lot of ribbons. He's absolutely right. And also the other thing is this, look at pensions. So if you're trying to get private pensions to invest in UK infrastructure and UK private markets, that takes time, and you want that to happen.
If there's a risk to that, it's a government bond crisis. The scars from 2022 are still here. It hasn't happened yesterday, so it's pretty unlikely. If there's a crisis, it's more likely to be Western world, and we're nervous of longer-term government bond yields generally. But I don't think that's going to cause the downfall.
I totally agree. The way we're doing short-term bonds, without getting too technical about it, is a real worry. You get geopolitical influences. And my nervousness is if the economy doesn't if it's stable, we're fine. There's no doubt whatsoever. It's absolutely fine. The only problem occurs if you get into a situation whereby there isn't the fiscal legroom, basically, and you're in a position that you have to come back to the country for more savings, more taxes, things like that, and bond markets just won't wear it.
We don't want to be there. Nick, good point, and thanks, Guy, for your answering that. I'm going to direct this question at you to start with, if that's okay. So Kevin's asked, if the UK economy is in a dire situation, as many economic commentators say, why was the recent auction for 10-year gilt yields heavily oversubscribed?
So on the one hand, the UK government debt position versus GDP is not out there versus a peer economy or versus the G7. So we're not out on a limb in a relative sense. And then I think the yields available short term with the Bank of England base rate at 4%, there's demand there and credit spreads are pretty low at the moment. So there is the demand. Government is not on its knees with its cap in hand. So that's fundamentally why there's plenty of demand for government bonds. There's a different thing about that. It might cost more in the future for the government to borrow money. That's a painful scenario that involves financial repression, and fundamentally, the job of people like firms like ours is to protect clients from that inflation higher than interest rates.
Yeah. Guys, anyone to add to that?
Listen, I agree. I think there's still a market for 10-year bonds, without a shadow of a doubt, in the UK, and that will, it's a secure investment. It doesn't mean to say that the economy is perfect, though.
It's interesting, though. I mean, I wouldn't mind Guy and Nick's comments on this. It seems to me, though, that if you look back over history, if there's an economic crisis based upon the markets, governments don't tend to fall, actually. So, you look at 1967, devolution with Callaghan. If you look at Black Wednesday with Norman Lamont, and if you look at the Liz Truss budget of 2022,
Dennis Healey, all of the, agreed. None of them went to the pension.
You get a lasting effect, and the electorate doesn't forget. The electorate doesn't forget about, Black Wednesday, Liz Truss, all of that. But it doesn't mean government falls the next week. I just think that's, and with a large majority that the present government has, does that provide a degree of political stability, even if there's instability in international bond markets?
My only nervousness is we just don't have any wriggle room left. That's the problem. We have had a double chunky tax raising on the back of already a high tax base.
Yep.
And productivity, debt is high, taxes are high, bond market prices are high on any interpretation, and we're now looking at them as normal, which is a worry for me, right? Stock market toppy, everybody would say. The slight complication with that is if there are any outside fiscal events or any geopolitical events that you then get into a situation that you just can't service your debt. And the only way you're out of that is, yes, I will cut my spending or I will raise taxes all the more. Sure. We've just discussed how difficult it is to raise taxes, and they've already, one of the reasons we just don't think some of these are going to happen. And the cutting of spending has proven to be almost impossible, and the evidence is going up, not down. So that does form a worry for me, because you just need another bad event and the wriggle room has run out. That's my worry.
Yeah. Guy, final question for you, 15 seconds.
Got it.
Slightly longer than the last one, the shortest question you had. Do you think Rachel Reeves has delivered her last budget?
No. I think she will survive, but she won't be Chancellor at the next election.
Brilliant. Excellent. It looks like we're almost out of time for today. We've covered a lot of ground, from the Chancellor's headline measures to the deeper implications for tax, pensions, planning, investment strategy. It's important that we all maintain clear and timely communication. And what stands out is that this budget is not just about the numbers, but how we translate policy shifts into practical steps for advisors and help their clients plan and create and implement long-term, effective financial strategies to help them achieve their long-term goals. We've heard how fiscal drags, tax changes and market reactions intersect, and we've explored the opportunities, whether that's reviewing wrappers, rethinking estate planning or positioning portfolios for resilience. As partners to advisors, our role is to cut through the noise and help you give clients clarity. Consumer duty reminds us that outcomes matter, and this budget is a chance to demonstrate value by acting quickly and strategically. If you'd like more information about the budget, you can visit our dedicated hub via the link on the screen. We'd really appreciate your feedback. Please take a moment to fill out the form provided on the right-hand side of the screen. It helps us make these sessions even more relevant and engaging for you. We referenced earlier on the 3rd of December, we'll be hosting another webinar with Guy Opperman and Mark Polson from the Lancat, hosted by Ed Walker. The panel will discuss the retirement paradox and its impact on advisors. And they'll also present a new thought leadership paper offering fresh insights and practical guidance. If you'd like to register, please visit the link on the screen. A big thank you to our panel and for the insights, and thank you to all of our listeners for joining and your questions. If you'd like any support in applying these changes or to discuss client case studies, please don't hesitate to get in contact with your usual Rathbones contact or get in touch directly. We're here to help you turn policy into opportunity. On behalf of Rathbones, I'm Mike Kempster. Stay focused, stay proactive. Let's continue to deliver confidence in a changing landscape so our clients can invest well and live well.